people understand the standard course of action, but I thought it was going to be really easy. I thought this was like a 2-minute classroom, but it seems that perhaps we need to spend a bit more time on it. It's really not a difficult concept. It's a simple concept of of things like flags, wedges, all the kind of standard price action elements, but from an order flow point of view. And from an order flow point of view, we can also overlay this with order flow as well to make sure that the story is complete. And when you kind of look at it from a complete storyline, the what happened on bonds is a really easy example. Actually, we took a screenshot of it so we could show you the trade anyway. So a worthy example to think about in terms of what we covered in classroom and what we covered in the article. So you can see a couple of things. First of all, we know that bonds generally make decisions around the halves and the whole prices. So there's a half price there. But outside of the fact that there's a half price there, what are we thinking about in terms of the supply demand, about reducing and expanding supply demand? So the simple story is this. In the case of a move that's coming up like this, and we see this starting to develop here. Now, at this stage here, there's no story. There is no story. At this point here, we would suggest that at this point, there is maybe increase in demand here because we don't know anything else. And there's maybe going to be increased supply there. We don't know anything else. So if that's the case, at that stage there, when we have the first pullback here, there's nothing for us to really think about. There's nothing for us to do at that stage there. All we're doing is waiting to see how the supply demand comes in. Now, we'll touch on the order flow in a minute, but at this stage, all we're trying to do is figure this out. So when this price goes bid, at that stage, of course, something changes. The supply demand dynamic changes at that point. Because obviously what's now happening is that what's going to happen here, assuming this price taps through the top edge here, is that demand here is going to increase, is going to start reducing. Let me say, why does demand reduce? Obviously, any buyers that are in there are sellers, higher prices, and various other things. So when this seller comes in here, there's obviously sellers there, which means there's going to be demand at lower prices. So there's a lot of things that can cause the demand to start changing. It can be something to do with the sellers, and it can be something to do with the buyers. The simple rule of thumb is that if the price pivots at a higher price, we classify this as a reducing demand story because buyers have already come in. Until the buyer comes in, we don't know that there's going to be reduced demand. But the buyers are coming in, and we can now call that a reducing demand story. So at that stage, based on pure price action, I am seeing a reduction in demand. And therefore, and this is the big point we make here, if I then classify this as reducing demand, and this is the big question, if I want to buy this, it needs to be lower. You see how easy that story is? If I want to buy this, it needs to be lower. So obviously the idea here is that we start watching this process. Now, the interesting thing that happened was that we were expecting this to then take out the high, which it didn't do. What it actually did was it came up to the high and then sold off. And obviously what that does is it reduces the supply. So in other words, instead of this line going up, this line's now flat. And what that tells me is we've now got a reduction in the supply coming in as well. So this is even more interesting now because what that reduction in supply does is it gives me buyers at higher prices. Because anytime you see anything that says reducing demand, it means we've got sellers at lower prices, reducing supply, buyers at higher prices. And we want to tap that either to get a big move or to use it as liquidity to trade into. So we've now got this storyline of buyers at higher prices because supply's gone. So that should be pretty obvious. And as soon as we've got this reducing demand, we now have this storyline here, which also says the same. Sellers at lower prices. So we've got all these pieces of the jigsaw puzzle now. So obviously what happens in the case of the bonds, as you can see, is we then get into the lower price. Forget the order flow. We then get into the lower price. And there's the lower price there. So we get into the lower price and we're expecting to see sellers at lower prices. And I'm going to be looking to buy from those sellers. It's called a level 2 buyer. It's called a commercial buyer. So when we see that storyline starting to form, I have my target price here, because obviously what I'm doing is I've got buyers at higher prices above this price level. So I can put my target price there. I know I've got buyers above here, so that's great news. And obviously what I'm doing now is I'm buying on the angle. So the angle is this idea that we're always asking for that little bit more every time we see this failed auction story. So when we saw another lower price here and it pivots and it comes down, I'm already thinking about a buy trade in here at 16. I'm already considering that as a real probability. And you can see it turns out to be almost exactly the pattern that we draw for you 1,000,000 times at bottom edges. Yes, 1,000,000,000 times. I think probably we've reached 1,000,000,000 by now. And that pattern, of course, is this classic pattern here. Is it just not the same storyline discussed in an open interest point of view? Is it not the same storyline? It's just the same storyline, guys. It's nothing different. I don't know why it's so difficult. But from an open interest point of view, we did the math yesterday so that you could understand the idea that that is absolutely true, because that drop off in open interest, when people get it, when volume gets used, it drops open interest. And sometimes, of course, that's useful to us because that takes away supply at the higher price. If you think about it, okay, so let's try it from a different angle because it's still obviously not quite sinking in. Can we agree that there is not unlimited numbers of contracts? Yes or no? Because contracts cost money. And the basic rule of thumb is if you've got a $5,000 account, you can only trade so many contracts, right? If you've got a $5 million account, you can only trade so many contracts, right? So there's no debate about this. So let's assume the world of contracts is, let's assume there's 100 lots on the buy and there's 100 lots on the sell, right? So that's the universe of total contracts, okay? So for this theoretical exercise, this is the universe of total contracts. So let's assume that when we hit a pivot price, 20 contracts always trade. So obviously, if 20 contracts always trade, how many sell contracts traded there? 20, okay? So obviously, how many buys traded here? 20. How many sells traded here? 20. How many buys? Well, those 20 buys got sold, right? So what's happening here to the universe of trade? So after that price break structure here, what is the current reserve of orders? What would the current reserve of orders be on the short side? Well, we technically could have had 20 sellers here and 20 sellers here, which means we've used up 40 shorts, right? So the sellers have about 20 contracts left, yes? Sorry, 60 contracts left. Do you agree with that? So the seller has about 60 contracts left. How many have the buyers got left? Well, the buyers have just been cleared out here. So at this stage here, the buyers or demand is 100. Do you agree? Because there's nobody got a position here on the buy side. The buyers get stopped out. When the pivot price comes in, the demand goes down to 80. Okay? So when the pivot comes in, obviously 20 lot buyer came in here, yeah? So let's just take it up to there. We won't take every swing, but we'll take it up to there. So what happened to the demand? Well, the demand started to increase, drop down, sorry, to 80. So when a seller comes in again, here, and here. So when a seller comes in again, how many contracts have the sellers got left? 40. So the sellers have got 40. So what's happening to that trade? How many demand? When the price breaks the structure low here, what does demand do? Demand goes back up to 100, doesn't it? It doesn't mean they're all going to buy it. That's not what we're saying, right? We're saying how many contracts are available to be bought here. If you are completely flat, if you're completely flat, you've got your entire account available to buy this, haven't you? If you want to. It doesn't mean you're going to. It means if you want to, you've got your entire account available. So when we see this going from 80 to 60 to 40, the supply is being used up, isn't it? And it's not getting anywhere. So it's not like they're using profit takes at the bottom edge and they've been able to pile out of the trade, is it? It's not like they've achieved any real targets. So it's realistic to think that there is still only 40 contracts left. In other words, there's a very significant reduced supply at the top edge. Who's going to add to a losing position, Rod? Nobody, right? Or at least nobody professional. But if we've now got 60 sell orders in the market, how many buy orders have we just created? We've just created 60, right? But where are those buy orders, Miguel? Top edge, right? So the buy orders, which in this case we'll just call it demand. I know some people will probably shout at me, but we'll call it demand because there's a demand for buy orders, so we can justify calling it demand, is now 60. So let's just think about that for a second. What's just happened at the top edge here? Demand is bigger than supply. You see that? Demand at the top edge has just become bigger than the supply at the top edge. Is that not I don't know, is that not a wow moment? Is that not when people look at it and go, wait a second? Because certainly the first time I kind of considered this from an economics point of view, it was like, wow, that makes a lot of bloody sense. So when you think about rising demand and supply coming in, it reminds us, of course, of our classic supply-demand curve narrative that we've tried to get you to understand many times, which is still a challenge, I think, for a lot of people. And that is that the supply line is this shape here. And of course, we've got the demand, which is this shape here. And we've got the supply-demand economics 101 type idea. We've obviously got price here. And we've got volume here. So we'll just make sure we're completely clear about this. Okay, so the blue line is demand. And the red line is supply. Simply read, as the price rises, supply should increase. And if supply increases and demand decreases, the price then tops out and reverses down. But what if we go to the higher price? Now, we've just established in here that at a higher price, Jesse, demand is bigger than supply at a higher price. So in other words, what I'm asking you to think about is if demand is higher at a higher price. So in other words, this is going upwards, right? Higher price. So if demand is higher at a higher price, then of course what's happening here is this line shifting significantly. This line shifting higher, right? This line is now shifting strongly higher. And obviously what we're now expecting is that we're now expecting this to start painting something that looks a little bit like this. Now, obviously that means that, what's going to happen is that if that goes higher, this is probably dropping out of that as well. Because if the volume's not increasing specifically, and the volume stays roughly about the same, then of course this has to shift as well. So in other words, the balance shifts. So we move from a normal fair value balance, which was originally in here, and the fair value balance is now here, which means, of course, that there might be opportunities to buy in here, because obviously there's not going to be any selling until higher prices. Now, if you understand that, you'd have joined me in this buy trade on bonds anyway, because, well, we were bullish bonds, as you know. We had already called this one this morning. We talked about it this morning. But in addition to that, we also had another piece of information. We also had another piece of information which is called order flow. Because obviously, when we're now seeing this demand increasing from a price action point of view, did we actually see demand increasing? Well, look at all that selling delta. So that must mean that demand's increasing at higher prices because we've got selling delta, right? So if we then look at that compared to what we're seeing here, we're now asking and now saying to you guys, well, you can now talk about this. Now you can talk about this. Demand is now increasing at higher prices, isn't it? Demand is actually increasing at higher prices because I can see it. I can actually physically see the demand being created at higher prices. So that's even better news. Well, one of the things we know is that generally this is asymmetrical. And it's asymmetrical because if we go back to this chart here, as demand increases, supply decreases, yes or no? So as the demand increases, supply decreases. So in other words, if we go to the left-hand side where demand increases, then supply decreases. You know, and if we increase supply, demand increases. Sorry, demand decreases, right? So one of the things we recognize is it's asymmetrical. One creates the other. So if we've got demand actually increasing, then we can also then state that there's a very high probability that supply is decreasing at lower prices. And what that means is that if we're going to try and find supply, where have we got to go to get supply, Jesse? Where have we got to go to get supply? Significantly higher, right? We've got to go through, clean through the top edges, possibly all the way to the next wholesale price level, possibly all the way till the buyers clear out their positions, because that's supply, correct? So where'd the buyers clear out their positions? I'll give you a clue. It begins with the letter M. Measured move, right? So we're already aware that the buyers in here have supply somewhere higher up here. So supply we expect to start increasing. Supply we expect to start increasing maybe at some wholesale prices above us, but they are going to be above us. Make no mistake about it. So if I know that the supply is going to decrease at this price, I better put an arrow in there in case we forget. So if we know that the supply is decreasing at this price, we know that the supply is only going to increase at higher. And we can put that on our screens. So we start understanding that supply will only increase at higher prices. And that allows us to run this buy trade through to a target, doesn't it? Which means that I end up with a 5 lot that makes $5,000 a contract, which is pretty good. And it's not that difficult, is it? We already had a bullish bias. We already talked about that storyline this morning. We'd already dealt with this storyline. We saw that demand is actually increasing at higher prices, which means supply is decreasing at the high price. So if we're going to trade this, we want to always make sure we go through that price, which is basically the order flow classroom we've done many times over for the last 10 years, this order flow class. All we've done is we've now tried to get you to understand it from an open interest point of view. There is a finite number of contracts coming in, and the idea is that what we try and do in this room is we try and find these supply and demand imbalances. So when the supply and demand imbalance generates, we get a great opportunity. What does this remind us of? What does this story remind us of? It reminds us of the fast, slow storyline, doesn't it? It reminds us of the tortoise and the hare, where we start to understand the reason why fast and slow is a thing. Because what does slow create? What does slow create? Well, let's think about it. So if we get a fast money move, if we get a fast money move, and then we get this kind of slow, kind of phased situation here, you see what's happening? The supply is getting used up with these sell orders here, right? And every time we take out a low price, the demand is reestablished at 100%, right? So the demand is getting 100% every time it drops into that bottom. And the supply is getting less and less and less into the top, correct? Now, if that's also matched by then some real sellers coming in, getting held at maybe a higher price, so maybe we come up here and then all of a sudden, for example, the delta sells and we get this trap in here, well, that's now even more evidence that this is going to go north, isn't it? It's almost 100% certain at this stage that that very weak top edge, because there's now a massive imbalance of supply demand at the top edge. So the massive imbalance, because remember, this imbalance can be shown as for example, arrows. You know, the amount of supply here is that size, and then the amount of supply here is that size, right? So we're starting to see that size dropping off. The amount of supply here is now that size. The amount of supply is now that size, right? But obviously, what happens on the other side of that is that the demand is obviously also now increasing and changing, because every time the supply drops, the demand increases, doesn't it? So the demand increases because obviously it's all of these sell orders combined, really, when you think about it, right? So by the time we get into this crappy little candle, the demand is now like that. You understand? Does that diagram make sense? So obviously, if we've got demand here and we've got a massive imbalance of supply and demand here, then the obvious trade is simply to then look at this and say, well, the obvious trade is that's going to rip a hole right through the top edges here. Now, that's assuming you want to be long this market, and that's the next question we need to try and answer is, do we want to be in a long position here, yes or no? If we want to be in a long position, this has got to be the play for us, hasn't it? It's got to be the play. So when we see these things, it becomes one of the most incredible breakthroughs. If you just think about, because I mean, as a floor trader, you know all of this stuff because you're dealing with this every single second that you're on a floor. You're looking at who's currently maxed out. You know that if they're maxed out and they're under pressure, then that's a good thing for you because you might be able to get something from them at a massive discount or whatever. So it's this using up of liquidity for achieving absolutely nothing that creates massive imbalances on either side of the book. So all of these sellers, the buying is creating 100%. Because every time your buyer gets stopped out, the size of their order stays static, doesn't it? It doesn't change. So the buy remains. And obviously, because of supply demand economics, the lower the price goes, the more demand as a rule starts to show up anyway, right? Just basic supply demand economics. So even by taking it from a supply demand economic storyline, we still end up with this massive demand imbalance at the top edge of the market. And then we see the imbalance at a higher price in terms of what we call the top right hand held bid or whatever. We can see that and we can then take advantage of that story as well. Now, if I like my bonds, sure, on the long side, we get a great opportunity to add a little bit more business, didn't we? On a 1 minute chart, you'll see it beautifully. So let me get a cheeky little 1 minute. So now we've got my cheeky little 1 minute. Remember, we were buy side. I've already shown you the screenshot for that, so we don't have to prove the buy side. But can anybody see the supply changing at the top edge to a demand top edge? Well, we can obviously recognize that we get this storyline here of lower lows. We get a lot of volume coming in here, and you can see that we get in a lower high here, right? So when we see that lower high coming in, it's starting to build a story that I'm very, very keen on. You see it? Might not yet see it, so let's just make sure you're going to get it. So there's the storyline that I'm keen on. Now you might be saying, but surely that storyline was visible from an earlier point. No. Yes. No. Surely you're cherry picking this, Ray, because surely that high down to this high here could have been a story. Therefore, you could have been buying this one. No. Why could I not be buying that? Why could I not be buying that? I mean, the story that we're talking about in terms of the shape of this is correct. Absolutely, right? So we take out the low price here. The supply is getting less, and we should be able to make a move. The reason we can't take that trade is because the belly is wrapping massively higher, right? So I'm not going to be a buyer regardless of what the story is, right? So I'm not going to buy it. That'd be stupid. As it turns out, it made money. So I don't, the point's still there, but I wouldn't be a buyer because I don't have any reason to be a buyer. And I'm quite happy to let this market sink. However, did that story change? So when we got this candle here, I am now seeing a very clear example of reduced supply, right? So I'm seeing a very clear example here of that supply that was coming in here starting to reduce as it comes into this area here. That supply starts to reduce as it comes into this area, which means there are an awful lot of those trades. What we're starting to see now is we're starting to see an increase, an imbalance on the buy side above us here. Yeah. And obviously, when we get this break to the downside, of course, now I'm starting to think to myself, right now we've got this storyline of buying on the angle again here, haven't we? The belly of the curve is divergent. So I've got a very strong story to buy into increasing demand. Remember, the demand is at the break lower here, the demand goes back up to 100%, doesn't it? Well, the demand isn't just 100%, it's a lot higher than 100% because we've got a, you may say, how do you get higher than 100%? What I mean is you're going to apply that demand in its entirety because the curve is flattening, which is great news for us. So we're really wanting to buy this big style. Bob is diverging. We really want to buy this big style, right? But we knew where we were going to buy it. We knew it was going to be a breakthrough of this area. We're looking for that trade. We're now looking for Voltics. We're looking for leans. We're looking for whatever we can get into this trade area here. And we're going to buy this, right? Because at the top edge, we're starting to see all the supply in this area here, this imbalance of that supply demand becoming very, very, very tasty indeed. So if I can buy at 24s, I know we're probably going to rip a big hole through 124.60s and a very high probability that we're going to clear the supply demand narrative at 24.16s at the top edge up here, aren't we? Well, that's exactly where we took the price to. We cleared that. And obviously, when we clear that, we might start moving into increasing supply. We might start moving into increasing supply. But just because we are doesn't mean we start selling it. One of the things we do, of course, into increasing supply is we start using our opportunity to book some profits into increasing supply. Increasing demand, a reason to buy it. Decreasing supply, a reason to buy it even more because that becomes a buy side level. And then we get this break of structure here all the way through to an increase in supply at the top edge. And we start using that increase in supply to decide whether we've got enough value. And obviously, there is a problem here because the belly is still relatively steep at this stage, isn't it? The belly hasn't really flattened too much here. So I want to make sure that when I reach up into this supply, I think it's going to be real. So if I think that supply is going to be real, what am I going to go do at the top edge? I'm going to sell into that increase in supply. I'm going to close off my positions and say thank you. And I'm going to get out for a $750 profit. Considering we had also the buy trade from earlier, I think that is a brilliant bit of business. You not agree? So fast and slow is also a thing. Fast and slow is real. Fast and slow allows us to make the connection between what we see in our charts and the reality of trading. Nobody agrees? Well, we'll move on to something else then.